Let's take a deep dive into stablecoins, tether settlement, why maybe, just maybe, your money is safer in stablecoins than in the bank, and much more. I believe that stablecoins are the best way to get a new person into cryptocurrency, as you can earn 6 all the way up to 12.5% on some of these centralized lending platforms. Welcome back to my channel. On this channel, I like to talk about ways to make money on your phone, creating passive income sources, making good sound investments, and some helpful tips here and there. If you like this type of content, then hit that like button, subscribe, and click the bell notification so you get notified when I make videos in the future. Also, as this will be a little bit longer video, I put timestamps in the description below so that you can skip to whatever part you're mainly interested in if you don't have time to watch the whole thing. And as always, I am not a professional on this topic, so do your own research before jumping into anything I talk about on this video. And I put together a nice little spreadsheet of all the exchanges, brokerages, and lending platforms I use or have used, the fees associated, if any, what I think of them, and that referral bonus when using my link or anyone else's. You will get $10 to $30 in free Bitcoin for signing up and following a few simple rules. Tether, the largest stablecoin by market cap, just settled with the New York Attorney General's office, admitting to no wrongdoing but still paying an $18.5 million fine and agreeing to not transact within the state of New York. This case has been going on for about 2.5 years, started in 2018. If you have been in the cryptocurrency space for a while, you've likely heard something about this and may have followed along. If you're new, this is a big win for stablecoins, as we hopefully can put this behind us. Short story is, Tether was accused of not having $1 for every Tether that was printed. This was not proven, but the case was settled. So, I'm getting ahead of myself a little bit. What are stablecoins? Stablecoins are a cryptocurrency on the blockchain tied to a fiat currency or other assets, some centralized and some decentralized. As there are so many stablecoins, how do you pick a good stablecoin? Well, that all depends on what you are looking for. If you truly want to unbank yourself and avoid centralization and all the trust issues that come along with it, then you want to look at a decentralized stablecoin, like DAI for example, on the Ethereum network, meaning there is no person or entity controlling this. This usually does stay pretty stable, usually within a cent or two of the dollar, and also is the largest by market cap decentralized stablecoin. Now, to be sure there is a dollar backing every stablecoin created in the bank, you want a well-regulated, transparent, centralized stablecoin, preferably with a large market cap. And the only one, from my knowledge, that checks all of those boxes is USDC, or USD coin. USDC is the second largest stablecoin by market cap, behind Tether. USDC is created by Centre, with a lot of big players backing it, like Goldman Sachs, Silvergate, and US Bancorp, just to name a few, pegged to the dollar and 100% backed. It does have external audits to prove this backing, and runs on Ethereum, Algorand, Solana, Stellar, and more to come. So the biggest thing when choosing a stablecoin, in my opinion at least, is that there is a dollar for every coin minted. Side note, there are also stablecoins created pegged to assets, like Pax Gold, which is pegged to the gold price, and they have gold in a vault for all Pax Gold tokens created. You can actually buy Pax Gold and move it over to Celsius Network and earn interest on your gold. And stablecoins created for tokenizing the value of real estate. And I'll cover much more about this in another video. Stablecoins, unlike our banks, do not run fractional reserve systems, like our trusty banks that flash that FDIC insurance sticker to make you feel safe. Regulation does not allow stablecoins to do this. There has to be a dollar for every stablecoin created. In recent news, this is all heading towards central banks transacting in stablecoins. On January 4th, 2021, federal bank regulations allow for financial institutions to process payments in stablecoins. This can be faster and cheaper than the archaic SWIFT system we use today. Also, opening the doors for central bank digital currencies, CBDCs. As we've seen in China recently testing out CBDCs, and some other countries, the US is testing programs to launch these. It's probably coming sooner than most of us expect. Now, a central bank digital currency is not really a cryptocurrency. It's practically a digital fiat currency, which gives us even less control, as the government will be able to track everything we spend our money on. I will have another video coming out in the future on central bank digital currencies. But let's get back to the topic at hand. It is clearly stated that banks can now connect to the blockchain as validator nodes and transact in stablecoins on behalf of the customers. Some banks and politicians have tried to say in the past that stablecoins and cryptocurrency is dangerous, when really they seem like they could be safer than keeping your money in the bank. Let me explain. First off, with stablecoins, there is no fractional reserve lending, as a well-audited and regulated stablecoin is backed $1 for every coin created, unlike our wonderful banking system where this is not the case. Before stating my next point, a well-ran fractional reserve banking system is a good thing for the economy, as it keeps money moving through the economy, the velocity of money, measuring the amount of times that unit of currency is used to purchase goods and services in a stated time period. Banks used to have to keep a certain amount of dollars on their balance sheets for what they lent out, called the reserve requirement ratio. So if a bank was holding less money on their balance sheets than the required ratio when they closed, they would have to borrow money from another bank with excess cash on their balance sheets in order to cover that ratio. Now, to help with this crisis, the Fed says the reserve requirement ratio is now set to 0. Yes, they need to hold 0% of the money they lent out on their balance sheets. The Fed is pretty much just saying, go ahead and lend and don't worry about it. Yes, you heard that right, 0%. Starting on March 26 of 2020, this was put into place. So not to freak out too much, this is the Federal Reserve requirement. Any financially sound bank wouldn't do this. But just the option to lend the same money out over and over and over again without having to have any funds on your balance sheet just seems reckless and irresponsible to even allow this. But stablecoins aren't safe. Yeah, I have a hard time understanding this one too. Not to mention that FDIC insurance sticker that's on those bank windows that tells you your money is insured up to $250,000. Their balance sheet is $59.9 billion at the time of recording this video. You can actually check this on FDIC.gov. That will be linked in the description below. Fact check me on that. That won't even come close to covering any of the top banks in America if they end up going under. Bank of New York Mellon Corp is the 10th largest bank in America at $349 billion, which is almost 6 times larger than the whole entire FDI insurance balance sheet. And let's just jump over to the number 1 bank in America, and that is JP Morgan Chase, with $2.87 trillion on their balance sheets. So tell me how FDIC insurance is covering any of these large banks if something did happen. These numbers are in an article that will also be linked in the description below. And that was just the number 1 and the 10th largest bank. So that leaves me to think, who will be paying if one of these banks go under? Well, you probably guessed it. That would be us. We would be paying for this, as the Fed would just have to turn on that magical money printer that they have access to that seems to turn on just about all the time now. Must be nice to have that access. So after hearing all this, let's think about it. Who really gives power to the banks? I'll give you a second to guess. If you guessed we do, then you are correct. We give power to the banks. The more money we deposit, the more money the banks have to lend out and invest into assets. So without all of our money, the banks really don't have any power. So moving your funds outside of the traditional financial system into cryptocurrency, even if it is a stablecoin, you are taking some of the power back from the banks. And in cryptocurrency, many of these lending platforms are treating you so much better. The banks trick us into keeping our currency with them because it's safe. Now, I wasn't really around in the 80s, and the few years I was around, I sure wasn't researching this type of thing. But interest rates were around 10%. If you were around then, comment below and let me know if you remember this. Now, to be fair, mortgage rates were also pretty high. Banks, over time, have slowly cut down the interest rates they are paying you. Do you really think that they made less and less money and got worse at finding ways to make money over decades and decades and decades? No, they're just padding their pockets and the pockets of their shareholders. So for the common person like us, stablecoins are a great way to get into cryptocurrency, even if you don't want to jump into some of these volatile cryptos like Bitcoin, Ethereum, and some of these other smaller altcoins. You can move your funds into USDC, which is my stablecoin of choice, for all the reasons I mentioned earlier in this video, and earn anywhere between 6 and 12.5% interest on platforms like Outlet Finance, Voyager Brokerage, Celsius Network, and BlockFi, amongst some others. Referral links to all of these will be in the description below. And yes, I do get a little bit if you use my referral link. We both get the same bonus. Now what's really cool is even if you sign up with one of these and just buy a USD coin and meet the minimum digital currency purchase, you still get some free Bitcoin and earn that high yield on your dollar on top of it. Now, in the decentralized world, where there is not a centralized source controlling this for you, you can earn some higher yields on different stablecoins, but the interest rates are very volatile. So I just tend to stick to some of these centralized platforms right now, as they do give me a pretty stable interest rate. Now, I do use all of these platforms I mentioned, so I would not be referring you to something that I don't use and don't believe in. So what did you think? Did this clear some things up about stablecoins for you? If I was missing anything, or you wanted me to cover something else, comment in the description below. I could dig into that and put it in another video. If you are ready to move some of your funds outside of the traditional financial system and start getting these high yields that these crypto lending platforms are giving to us, then give yourself a raise. I'll see you next time. A few videos popped up to your left and right. If one of those perk your interest, give it a click.